And let's continue the tier list that we started a few days ago. If you didn't see episode 1, I recommend you to check in the description. I will put you the link. And here we go for the second episode of rating, okay, the companies that you proposed in the comment section on my previous tier list video. So if you have other companies that you would like to see, obviously leave it in the comment section and I will make some other video later. So first one, we'll go with Salesforce, okay? Let me remind you the graduation system, like this, you understand. S is really, really top quality, like great, super top quality companies. A will be very good quality. B, it's okay good. C will be okay bad, like B okay plus, C okay minus, and D a really bad company. And to remind you as well, I only invest in companies that I see in S or A. Okay, most of my portfolio is just these companies that are in A or S. So let's start with Salesforce. I have it in my watch list here. Let's have a look at the way this company had evolved. For the growth, we had a 10 years cumulative annual growth rate for the last 10 years, 21%, EPS 9.5%, so it's probably because here it wasn't profitable before. So 9.5% per year for the last 5 years, and free cash flow 32% for the last 10 years. We have an estimated growth rate for the earned EPS around 21% for the next 5 years. So it's a solid growth rate here. And the revenue estimated to grow by 9, almost 10% per year. When it comes to debt, we have very low debt. So this is good. Margins, we have a good operating margin. It was low before because the company was probably not very profitable. And the free cash flow margin got higher and higher. So this is good. We have operating margin getting higher and higher, free cash flow margin getting higher and higher. We like it. When it comes to efficiency, it's a bit low, to be honest. Return on invested capital 7.9, return on equity 10.1, return on capital employed 9.6. But I think if we replace all those return from the net income by the free cash flow, it should be better. So let's check this. Let's go here and compare net income to free cash flow, because I think they have more free cash flows than net income. So yeah, in red we have free cash flow, in blue we have net income. And as you can see, the free cash flow is almost, here is double net income. Let's put in LTM. So double net income, here double as well. Here we're like way more. Here is like almost triple. And before it was a bit similar. So it's double net income. So if we go to efficiency, it means that the return on the ROIC is around 15%, return on equity around 20%, and around 18% for return on capital employed. So it makes it way better. The capital allocation, we have 5%, okay, for the capex to operating cash flow, and stock-based compensation around 25%. It decreased since a few times. Let's check here, cash flow statement. Let's go here, stock-based compensation. Yeah, like, I'm not saying it decreased, but it's more stable here, okay? It's kind of stable since 2023. Now let's just compare it to, so stock-based compensation, let's compare it with cash from free cash flow. Where is free cash flow? Right here. So if we compare, yeah, we had like 3 billion out of 2, so 1/4. Here it was 2 billion out of 10, 1/5, yeah, 1/3 here. Okay, so it's getting better. You can see it here in capital allocation. It's getting better. Before it was 37. It's still very high, but it's getting better here. So for this company, considering, let's see how the revenue have evolved for the last 20 years. So very good, like up to the right, like this is some solid revenue, and the growth, we always had almost over 10% growth every year for the last year, since 2007. And now up we went to 8.7%. So we'll see how it will grow. The analysts expect it to grow by 9-10% in the future. They have low debt. They have some solid returns. So I would put Salesforce in S, like very high quality company. The only problem here could be the stock-based compensation, but I want to say most of the company with in tech, okay, especially in CRM area, they have all this. They have a very high stock-based compensation, so it's something that all the market kind of have. So I'm not very worried about it, especially that it seems that they start to control it. Microsoft, great company. You have a full analysis of Microsoft on my channel that you can check if you want. Let's type it here. So the growth, we have like amazing growth, estimated 14% for the next 4 years. Same with growth, EPS 15%. It grew by 10% per year for the last 10 years, 25% per year for the last 10 years. Really amazing. Same for free cash flow. All like really, really good. You have very low debt, so no debt problem at all. Margins are increasing. They're getting better and better. 10 years ago, it was 19% operating margin. Now it's almost 45%. Free cash flow came from 25% 10 years ago to 30% now. So this is really good. Even the gross profit margin is increasing. So this is great. Return on invested capital, same, increasing and higher than 20% now. Return on equity increasing as well. Return on capital employed increasing. We like this. Stock-based compensation are a bit high. Same for CapEx, okay? CapEx to operating cash flow, 37%. I would prefer it to be under 20%, but considering that they have this kind of return with the capital that they use, could be fine, okay? It could be fine, especially that they need a lot of CapEx to develop the cloud business, because the cloud business is, most of the cloud people, they have problem that they don't have enough capacity for their cloud, so they cannot accept all the clients that they could have. So it's like the first ones that get more capacity will be able to have the client. So this is how it goes. Let's have a look if they do some buybacks. I think they do a little. So yeah, minus 80, let's say minus 1% for the last 10 years. For the last 20 years, almost minus 2%. And for the last 30 years, minus 1% on average per year. Since they started to do buybacks, it was approximately here, yeah. Between 1.5 and 2% historically, but let's focus on the last 10 years, 07, 06. They a bit stopped, okay, the buybacks lately, but they still do some, so it's good. You can see the margin getting better, low debt, so yeah, Microsoft, it's a solid S. Siemens, I don't know this company. I mean, I know the name, but I don't know what they're doing. Which one will it be? Let's go with this one. So Siemens, technical focus on areas, automation and digitalization in environment, common percent. Okay. Let's see the growth. You don't have a lot of growth. Okay. It's not a company it's not a compounder. Okay. Very little growth. Estimates are kind of fine, to be honest. You don't have a lot of analysts covering it, but estimates are kind of fine, but the low is not really good. The debt is fine, 2.59. It was 5 years ago, 4.6. So they reduce that debt. This is something good. Debt to equity, 84% is fine. Interest coverage, 6.98. It's fine. It's getting higher. Okay, I would prefer over 8 or 10, but it's around 7, so it's not that bad. Margins. They increase the margin, but they're still a bit low. 12% operating margin for me is too low, okay? Free cash flow margin, same, is too low, even if it's increasing. Efficiency, the return on invested capital is too low. Same for the return on capital employed. And return on equity is fine. And capital allocation, apparently they don't do a lot of stock-based compensation. They have some capex, but not too bad. Let's have a look at the net income to see if there is a big difference with the free cash flow. For Siemens, okay, they have slightly higher free cash flow than net income. Okay, a bit like they had for Salesforce. Let's check again. So if they have higher, this will probably go to 12, eventually 13. Here, same to eventually 10, something like this. So it's still a bit low. Let's have a look how the revenue have grown for the last 30 years. And you see it's super flat. You don't have growth here. It's super flat. I don't like it. If you look at the growth, it's go up, down. I really don't like it. Let's say, yeah. For the last 30 years, it wasn't very good. Quarterly, the same. Let's have a look at the net income. Okay, we want 30 years. Same. We don't have much growth. Let's put it from 2001. We have a bit of growth, okay, it's 6% per year, but it's very unstable. I don't like unstable like this. So this one, I put it in B because it's not bad. It's a company which is profitable, okay? So eventually you can have something to do if you have it at an extremely good price and you're not a very long-term investor. So, and you want to do like some bet for a year or two or eventually 3 on a very deep value bet. So why not? But you need to check the valuation here. So it's a B. It's like a OK plus. It could be a OK minus if the debt was way higher. But here it's OK plus because they still generate some free cash flow consistently. It's just they don't have a lot of growth. Let's check Dollar General. Dollar General. Guess it's this one. You have 7% growth per year for the last 10 years, 2.9% per year. It's negative lately. They estimate 9% for the next 5 years, 4% for the next 5 years, sorry. Debt to EBITDA is way too high. Interest coverage is low. Debt to equity is too high. Margins way too low. Free cash flow margin same, way too low. Return are way too low as well, and they are declining. All of this is declining. Here, all of this is declining as well. We don't like it. Capital allocation, too much capex, way too much capex, especially for a Dollar General company. Yeah, I don't like this. Revenue, they still have a stable growth of the revenue, but if we look at the net income, there is a lack of profitability lately. Okay, they have growth of revenue, but they cannot have good net income, so the operating margins are probably declining. Yes, operating are not really good, and the operating income are not really good as well lately. So yeah, because of all of this, this is a C. It's a C, it's not a D, because if you feel that maybe they can rebound and gain in margins and so on, why not? But yeah, it's between C and D, okay? Is between C and D. I will put C because, yeah, it's between C, difficult to say. The problem I see here mostly it's a debt, okay, where it is financial health, debt to EBITDA. It really grew like since 2021. It's out of control. Even since 2019, it's getting out of control. Interest coverage were good till 2023, that they became not really good. So I will put it here, because it's obviously a business that don't have a high margin. It's normal that they don't have high operating margin, but at least they could have it stable, not have it declining. So I put it in C, because if they got better in the next 2, 3, 4 years, they could go to B. But for now it's in C, and if they continue getting bad like this, especially for the debt, they will go in D, but for now it's a C. ADM, Archer-Daniels. It's a well-known company for dividends, like 420 dividend yield. Okay, 54% payout ratio. It's pretty good. I think they pay a dividend since, I think they are king dividend if I don't make a mistake here. Let's see the growth. Very little growth, okay, 2.6%, 7% for the last 5 years. Same with EPS. The estimated growth for the EPS for the next 2-3 years is 9% per year, which is pretty fine. Let's look at the debt. Debt to EBITDA, it's okay, not too high. It's at the limit, okay, it's around 3. Interest coverage is a bit low. Debt to equity is fine. Here, like, yeah, it's very low. We'll need to see how it evolves. Margins, they are stable but very low. Okay, operating margin at 2% is really, really low. Gross profit margin are really low as well. Efficiency, same. All of this is low and declining. Don't really like it. Capex to operating cash flow is very high. Stock-based compensation is fine. Let's have a look at the financial health interest coverage. It always had been not really good except 2001, 2022. yeah, so I don't like it as well. I don't really like it as well. All the margins are pretty low. Let's have a look how they evolve. Okay, so operating base we had was 5.6%. The decade before, never ever over 5%. And here, 8% in 1995. So they never had a high operating margin, so which is kind of fine. Let's see if we have some buybacks. We have little buybacks since the last 5 years. Okay, 4.5% per year, which is solid. For the last 30 years, 2% per year in average. Okay, 1.5 for the last 20 years and 2 last 10 years. So this is something good. So let's see how the EPS evolved. Yeah, EPS is a bit unstable. Okay, especially 2007 till 2021, nothing happened. With this, we don't really like it. Net income, how did it evolve? I guess probably the same as EPS. Yep. This is too cyclical. Revenue higher, but same 13 to 21, nothing happened. So yeah, this will go at same. The margin are very low, so I will put it here as a C with Dollar General. They have better debt than them, but for now it's a C. Yeah, it's not a really great company. Maybe for some dividend investor, if you have some that want dividend, if you're focused on dividend, maybe we can go on B. But for now, I put it on C. Enersys. I don't know this company. It's first time I see it. Enersys, very slow growth, very slow EPS growth as well, except for the last 5 years, but the revenue didn't grow very good for the last 5 years. They expect to continue a solid growth of EPS for the next 2-3 years, same, and a low growth for the revenue. The debt is fine, good interest coverage, debt to equity is okay, EBITDA okay, margin, operating margin are fine. Okay, they're just at 10%, not really good. Do they do dividend? They have a little dividend, okay. Gross profit, it's fine, it's growing a bit, okay. Efficiency, return on equity is getting higher, return on capital employed higher. All of this is getting higher, but it's not really good same as well. Like, it's very, like, it's not exceptional. Like, it's not exceptional. It's fine, but not exceptional. Stock-based compensation, fine. CapEx to operating cash flow, fine. Let's see how the revenue looks like. Okay, it's growing correctly at 11% per year for the last 30 years. It's fine. Let's see how it did do for the net income. Okay, it did good as well. Let's put out 2002. Okay, for net income. We had this here. I don't like to see this, what happened between 2013 and 2023. I don't like it. Need to understand why this happened. Do they do buybacks? Yes, they do a bit of buybacks. Okay. The EPS will look probably the same. Yeah, we'll put this like this. So yeah, same. This area, this moment here, I don't really like it. So I need to understand what happened. So operating income, was it good? Same. Okay, we had this flat moment. So yeah, this company I would put, I think they are a bit better than Dollar General and ADM, so I would put them in B. But yeah, those B and C's, it's difficult because they both okay company, but one is okay plus, one is okay minus, so it's difficult. They kind of all of them can be, we can change B and C for all of them, so it's a bit difficult. Markel, let's have a look at Markel. Markel Corp, which is specialist in science product. Okay. The growth. Solid for the last 10 years, 14 years, 5 years as well. Okay, solid growth. Estimate, negative estimate for the EPS. A little growth for the net revenue. Debt, they don't have debt. Okay, margins. Oh, great margins. Okay, we'll have a look at this. Efficiency, it's a bit low, but if it's insurance, it's kind of normal. Okay, return on equity is good. Let's have a look. Okay, let's have a look. How did the revenue do? Okay, we like this. This is the kind of thing we like. Is the net income doing same? Oof, okay, they have a lack of profitability sometimes. I don't like this. I don't like this at all, that they go up, down, up, down. This I don't like. I don't like. Let's see if operating income do the same. Okay, it's the same for operating income. Don't like it. I'm not a big fan of this. Let's look, how did the margins evolve? So yeah, sometimes they are good, sometimes they go back. Return on capital, same. Okay, I don't really like the way it fluctuates. So yeah, this one will be, it's a B or a C. I would put it as a B because they have some solid growth in revenue. It's very stable compared to the other one. For the revenues, they just have some lack of profitability sometimes. So it's a B, but yeah, same. Always like the B can be C and C can be B. It's a bit difficult here. Okay, I don't have it yet with margin because we have only companies that are listed in US now. So they have we have some OTCs and so on, but we don't have international stock yet. I mean, all the one. So Brunello, Cucinelli. Maybe I didn't put Brunello. I have it. I have it here. If I don't have the right name, it will be difficult. So 10 years, 13%, 23, 12 here. EPS 3%. Okay, we need to have a look at this EPS and the revenue. Revenue, we like this. Okay, very steady one. Net income. Okay, 41% cumulative annual growth rate. Let's see for the last 5 years. 30%, 10 years, 16, 20. Okay, there is, okay, 2020 is a bit exceptional, but so, okay, good. Per share data, do they do some buybacks? They diluted massively here. What happened? I will check with another one, with FinChat as well. Do they have the same problem? Here they don't have the same problem. With this, it seems that we have, let's see, the diluted, same diluted, they don't have this, so it's probably a little problem here with our data. It seems that it's stable, very, very stable. Let's see the net income, if it was kind of the same. Yeah, so net income was fine. We just have the problem with the operating, so the EPS will be looking same than net income, I guess. Yep. Let's have a look now at the ratios. Margins, gross profit are fine. Operating are getting better and fine. Capital efficiency, return on equity is fine. Return on capital employed is pretty good. Bruno Cucinelli is pretty good here. We have some nice things. Okay, return on capital employed. Return on invested capital is a bit low, but the capital employed and return on equity is good. Capital allocation, CapEx is really high. Okay, the CapEx to operating cash flow is really high. Dividend, I doubt that the dividend yield is 10%. I think we had a mistake here. It's 1%. So there is 1 more. Okay, and let's have a look at the debt. The debt is fine. It's a bit high here. It's a bit high here. Here it's fine here, but those two, I'm a bit concerned by the operating income and the operating cash flow. Operating income go good. When it comes to cash flow, operating cash flow, it's a bit more difficult than the operating income, but it's still fine. Okay, and the free cash flow, still fine, not exceptional, but fine. It's good. It's good, not exceptional, but it's good. It should be like between B and A, this one. This one is clearly between B and A. Okay, compared to the other one, Brunello Cucinelli is better. So I would put it in A. But for me, it's a little A, okay? It's A between, it's between B and A, okay? I put here because I find it better than all of these 5 companies. So it's either I put those 3 down to C and Brunello Cucinelli on B, or we keep it here. So Brunello Cucinelli will be in A, okay? But it's not a company I will invest. Like, it's definitely not a company I will invest. Rio Tinto. Rio Tinto, I think I studied a bit few years ago, but like very vaguely. And they are super cyclical, if I remembered well. Yeah, like you had a cycle here, down, cycle up. Now maybe we'll have a cycle down. Let's see with the net income if it's the same. Cycle up, down, up. Okay, yeah, it's the same, very cyclical. Let's have a look a bit at the debt, how it is. Debt to EBITDA is low, coverage, this is good, margins, they are good, gross profit, free cash flow margin, cyclical as well. The efficiency is good, okay, capital allocation here. You have a lot of capex. I don't really like this, even 5 years average is a bit high. So yep. This one, I find it too cyclical. So for Rio Tinto, it's too cyclical. I put it on B. Put it on B. They don't have bad numbers, but you need to buy them when you're in down of a cycle. And yeah, too cyclical. Restaurant brand international. If I don't say something stupid, I think a restaurant brand on Burger King, right? They have Burger King, Popeye, Firehouse. Okay. Timbits. Okay. Let's have a look at the growth. Yeah, solid classic growth estimated for the future 10. 5 here. Debt. This is a bit high, but it's restaurant, so maybe it's easier. Okay, let's just compare to McDonald's. Yeah, McDonald's as well have some high debt, but it's better. Okay, you can see the debt for McDonald's. It's way better. We can check Chipotle. Chipotle way better. Starbucks. What does it say for Starbucks? Same, it's a bit high. So it's a bit high. You can have better in the market. Okay, you can have way better in the market. So the debt for me here will be a red flag. The debt will be a red flag because when we compare to the other, they are more on the high range about debts than on the low range. Margins, operating margin are good. Let's compare the operating margin with McDonald's. So here we have 28%, was stable here. McDonald's, 40, okay, yeah. Oh yeah, I'm sorry, but restaurant brand will not be my favorite one here. It's you have better other return on capital employed is a bit low, return on invested capital is a bit low, stock-based compensation are a bit high, capex to operating cash flow is fine. Let's have a look, but I think we have some nice growth for it. Total revenue, we put 30 years. We have some nice growth. Net income, we didn't grow net income since 2022. So this not really like. I don't really like it, but it doesn't change that it's not a business, which is fine. So I put it on B. Okay, it's not a, it's a B because McDonald's and so on are way better. But it's not like a bad business. Next one, LVMH. It will be probably a A or a S. We have nice growth, except last year. Okay, last year wasn't very good for the company. Here, nice. Estimate growth 10.8%, 7.5. Debt, they have low debt, high interest coverage, which is good. Margins, great margin and increasing. Gross profit increasing. Free cash flow margin, good, little bit increasing. Return on capital invested capital is a bit low. Okay, it's increasing, but it's a bit low. But return on capital employed is increasing and good, over 15%. Return on equity, same. It's decreasing a bit, but it's still good. Capital allocation, they seem to have a lot of capex to compare to the operating cash flow, but seem to be kind of fine. Let's have a look at the total revenue. Okay, let's put it on 30 years. So yeah, we have growth and then a bit flat here. It got a little down, but we have some nice growth, 8%. Net income, some nice growth. Sometimes you have a down, but it go back after up. So all good. I don't think they do some buybacks. Okay, they have good here as well. Did they do some buybacks here? Very little buybacks, so it's pretty fine. The cash flow, free cash flow. How did it go? The free cash flow is growing same. They have trouble to come back to 2021, but it's overall still growth. So I like it. I will put it on A. Why is not on? It could even be on S. I will put it A because it's still less of a quality company than Salesforce and Microsoft, but it's a solid A. It's between A and S. So Brunello Cucinelli is between B and A. LVMH is between A and S. Okay, it should be in the middle here. So very, very good. Now what do we have? We still have a lot of companies here. Global payments. I don't know this one. Global payment. I will go a bit faster with this one. Global payment. Let's see the growth, solid estimate here. Okay, this is pretty good. Debt, it's a bit high. This is low. This is too low. This is a bit high, especially that it's growing compared to 5 years ago. This one is growing as well, so this is good. Margins, they are growing, especially the operating one is good. Same for the gross profit. Same for the free cash flow margin. Efficiency, the efficiency is too low. Oh, yeah, man. The efficiency is way too low here and it's decreasing. I don't like this. I like this kind of efficiency. Here, the return on capital employed, return on invested capital is way too low. Capital allocation is fine. Let's have a look at the revenue, how it evolved. Okay, so it's good. There is no cyclicality, so we like this. And for the net income, same. We just had bad 2022, but then it was a fast get back. So global payment, I put it in A. Okay, it's a A. It's a B, sorry. Oh yeah, it's a B because return on capital employed and invested capital is way too low. And if you want to have great compounders, they need to have some good return for this. Pinduoduo, PDD, we have some solid growth, especially for the last few years. We don't have a lot of data because it's public not very long ago, but the growth estimate still, it's the EPS, they don't estimate some growth here. Okay. For the revenue, they estimate some growth. There is no debt. Operating margin, 27% is really good. Okay. Free cash flow, same. Efficiency, we are very good as well. Let's have a look here. The total revenue, okay, up to the right. Let's look the net income. It got become profitable in 2021 and then it got good. Share outstanding. So probably in 2024, we have this decrease here, which is not really, really, like, I'm afraid that we have something problematic here for the share outstanding that we will need to correct. Yeah, okay, they are diluting the shareholders, so we don't really like this. So yeah, the company is diluting shareholders, but they have a low debt, so this is good. Okay, and if you look at the margin are increasing, so this is good. The efficiency is getting higher as well, so this is good. I put PDD as an A. PDD is a solid A. Why not the S? Because it's too young. We don't have enough history, we don't have enough data, but for now, for what they show, it's very good. Next one will be VICI properties. So here we have, with VICI, I think it's rates. Okay, so for rate, I like to use this website to analyze. It's simply safe. VICI properties. It's in casino, right? If I don't say something stupid, it's Caesar Entertainment. So dividend growth only 6 years, but I think it's a young company created in 2017. So this is normal. grow by 7.7% per year, which is fine. Dividend yield like 5%, okay. Adjusted fund from operation payout ratio, it's good, under 75%. We have some growth for the fund from operation, share outstanding growing, but it's normal. Sales growing, okay. Return on equity and invested capital, it's a bit low, but it's kind of fine. Margins are good. The debt is a bit high, okay. The debt is a bit high here. Even if it's under 6, it's still a bit high. And the return risk coverage is good. So yeah, this one's I would put it as a B. Okay, it's fine. It's a good company, but not amazing. Don't deserve to be A or S. Adobe. They have some trouble right now, especially about their moat question. It's really questioned. Let me know in comment section if you think they have a strong moat or no. Some people compare it to Google. We cannot, in my opinion, compare it to Google because Google, everybody in the world, except in China, but almost everybody in the world use Google, while Adobe, way less. We have some solid growth, okay, for the last years. The EPS for the last 5 years and last time wasn't very good, but they expect almost 20% growth, almost 9% growth for the revenue, so that's pretty fine. The debt is very low, so we like this. Margins are high, we like the margins. Efficiencies are high and improving, we like this. Capital allocation, same for this kind of company. You have high stock-based compensation, which is normal, so not a big fan of this. Let's see how the operating income evolved. Okay, so yeah, since 2014 it's great. The only problem here, I guess, it's mostly about the it will be mostly, they do some buybacks, it will be mostly about the how do we call it, the moat. Okay, I think the main problem here will be about the moat because they don't have debt. The margins are like really good, okay, they're improving a bit. So yeah, it's mostly the moat which is a problem. So this one I put it as A because I don't believe that much about the moat. They have great numbers. If you focus only on numbers, it's a S. If you put the moat here, I put it as an A. I'm not saying they have no moat, but I feel that they're getting more and more disturbed in their market and it's more difficult for them to gain new market share. Doesn't mean that they will disappear. Doesn't mean it's not a great company. It just means that they don't stand on the same, in my opinion, that Salesforce and Microsoft. For me, Salesforce and Microsoft are better. Arista network. Arista, they got destroyed today. I mean, at the moment I'm recording the video, they were down after the earnings, or it was yesterday. After the earnings, they got down. You have amazing growth, amazing estimate for the future. That's pretty solid. EPS same, great growth for the EPS. You have no debt for the company. A margin increasing and high. That's really good. Free cash flow same. Gross profits very stable. Efficiency increasing and high. I love it. And almost no capex. Very little stock-based compensation compared to free cash flow. Compared to all the tech companies, that's good. The main problem with Arista Network, you have a full analysis about this company as well in the comment section. In the description, I will put it, it's on my channel. The problem with Arista Network is that they have only 4 clients. I mean, they have 4 big clients and 2 clients represent barely like 30 to 40% of their revenue. I think you have Microsoft, which is 24%, and Meta, which is 13% of their revenue. So this is problematic. Even if they have a great moat, okay, the company is way better than what they have on the market. That's why they're gaining shares every year. They have really good product, especially a good EOS, a good operating system for their things. They get really innovative with this. So it's a great company, but only 4 clients. For me, I put it as a S. Okay, I put it as a S, but it can be tricky. In my opinion, if you own already Meta and Microsoft in your company plus Amazon, Arista, maybe you don't need it. But if you don't own Meta, Microsoft, maybe you can get some Arista. It can be good. Okay, Merck. I think Merck is one of the oldest pharma company, no? Overhead healthcare, when was it? Oh no, it was absolutely not one of the, oh yeah, it was founded in 1891. So yeah, it's very old. You have some stable growth. Here, you pretty much have same as usual. Last year it grew a lot but I think it was because they had some problem after, we'll check it. They have low debt, we like it. A great margin increasing, that's good, okay. Efficiency increasing and high, it's good. Capital allocation, it's very good. Let's see how the operating income evolved. So yes, they had a bad year here. It's 6% growth per year, okay. It's a kind of companies that grow every year, but slowly, but they still grow, okay. 4% here. We had some cyclicality for this business that we don't really like, but they don't have a lot of debt, okay. So Merck, I put it as a B, okay. It's a solid B. Berkshire Hathaway, okay. Now that Warren Buffett is not here anymore, let's see how it goes. For the revenue, okay, net EPS, earnings per share, that's not really good for the future what they expect, but it's okay. We had some solid growth. Debt, they have low debt. Margins, they have great margins, okay. Efficiency, so efficiency is fine. It's not amazing, but it's fine. And capex to operating cash flow is a bit high, but it's not the same type of business. It's an insurance company, so it's normal. You can see that the revenue got higher very classically. It's a A. It's a A. It's not higher than A because yeah, it's a great company, but I'm not sure it's worth the price. After they are mostly in the insurance business, so you wanna depend how you feel about all of this. Operating income, if you look at this, they have some solid growth, okay. They grow solidly their operating income. They are managed very well, okay, like no surprise. But I put it as a B. I don't consider having them in my portfolio, but they're still a great business. They will be probably between B and A. III.L, this I don't know this company. Like you put me in comment section like some companies that I have absolutely no idea. I don't know where you find them. I will be very curious like to understand where you find those companies, because sometimes I read them and I'm like, how did even you had the idea of this company? 3i growth, solid growth, like very solid growth for the revenue. The estimates are kind of good. EPS same, it's pretty good. That's here no. The debt, low debt, okay, great. Margin, this operating, yeah, we need to check this. Efficiency is very good as well. Capital allocation is good. Oh, this business has some good metrics. Let's see. Okay, yeah, I'm sorry, I don't like it. Like very cyclical revenue. When the revenue is cyclical, like I don't like this. Net income, same net income, which is cyclical. Operating income, let's have a look. Operating income cyclical. I'm sorry. It started well, but no, it's too cyclical. Operating margin, yep, before. Okay, they got they are very efficient, but it's too cyclical. No, so I don't really like the cyclicality of this business. It's a B, yeah, it's a B because they don't have any debt and so on, but not really good. Texas Pacific Land, amazing business model, by the way, for Texas Pacific Land. You own the land and then you just have people on it and you touch royalty every time they do something, so very good. Growth, very steady growth. Revenue growth 18%. The revenue growth will be almost the same that EPS growth, so that's good. EPS growth, you see, it's almost the same than the revenue growth, so this is very solid. They don't have debt. They have very high margins, very high efficiency. They have some capex, but it's a bit different, okay? It's normal because they buy land and then they touch royalties. You can see that it's going up straight. Operating income will be same, up straight. You have a bit of cyclicality sometimes, but it's just for a year or two. So this is good. You can have a look at the free cash flow. The free cash flow is one of the most impressive thing here, I think. Like if you take out 2024, it's really growing fast. So yeah, this is a great business. I put it at A or S, even potentially S. It's a bit too expensive now, but great business. Samsung, let's get to Samsung. Okay, I don't know which one we'll take. By the way, for people that are using our margins, this is something we're improving in the next few weeks, months, because we release the beta. Like what I'm using, it's a beta version of margins. So we still have obviously like some things to work on. And international company is something we are working on to have something very clear for international business. Overview, let's have a look. The revenue, there is very low growth here. EPS, same low growth. The estimation are pretty high compared to what they did in the past. Operating margin is a bit low. Return on capital is a bit low as well. Okay. Debt, they don't have debt. Let's have a look at the margin are not getting higher and higher. They're getting down. I don't like this. I don't like this. Net income, it's growing. Yeah, this margin I don't really like. Let's have a look at capital efficiency. Return on invested capital, it was high and now it's getting too low. So yeah, it's an A because they're good, they're profitable, they don't have debt, but I'm not a big fan. Pepsi, let's get with Pepsi. PepsiCo, what do we have? Okay, we have very low growth, but it's almost a sure growth. Like it's grow with inflation, so this is good. Debt, they have a bit of debt, but it's well covered, so this is fine. Margins, it's okay, 14%. I would prefer over 15%, but it's still okay. Efficiency, you have something which is fine as well. They are just at the limit, it's okay. A lot of capex compared to operating cash flow, but it's fine. And when you look at the revenue, you take max, it's going well, okay, 5% per year. You take the net income, it will be probably same, 6% per year, so they're increasing a little their margin. The number of shares outstanding, it's decreasing, okay, for the last 20 years, -1%, the last 10 years, 0.6%. So the EPS growing by 8.4%. So you have an EPS growing by 8.4%, and then you have a little dividend, okay, a dividend of 4%. Okay, the dividend yield is not 8%, it's around 3-4%. We'll check here, 4.3%. So if you have 4% dividend plus 8% EPS, you could approximately have 12% return right now, which is kind of fine, okay, which is kind of fine. I put Pepsi as a B. It's not an A because there is too low growth, okay, the growth is too little, but it's a solid B, okay, it's a solid B. If growth is not the most important thing for you, and you estimate that now, especially now that Pepsi start to be very undervalued, you can put it at B or even A if you take the value in consideration, but just the numbers, the growth is too low to be an A or an S. This is General Electric. General Electric, okay, no growth for the past. They did some spin-off, right, lately, low debt. Margins are getting kind of fine. Efficiency, it's a bit low. The efficiency, it's too low, okay. Capital allocation is fine. Let's have a look at the revenue. So the revenue is like this lately because they did some spin-off, okay, so it's normal. We need to see in the future how it will be. The net income, same, I guess we'll have the same. A lot of cyclicality. So here I put it now as a C or even a D. I put it as a D because I don't have enough knowledge. We need to analyze all the companies that spun off to see which one would be interesting, okay? But for now, with what I see, the way it went down, I need at least 5 or 10 years before considering it because right now I don't really like what I'm seeing. It doesn't mean it's a bad company, okay? I put it at a D because for me, for my style of investing, is not something which is in my circle of competence. I'm not good enough yet with spin-off and so on, especially with companies that I didn't really study before they spun off, so I will need to go very back in history to understand each section. So for now, I put it as a D. But if you are good with all of this and you understood very well everything inside the company, maybe it will be higher for you, but for me it's a D. American Express. Okay, they grow nicely. EPS nicely as well. Some growth for the future. Debt, no debt. Margins, amazing. Efficiency, pretty good. Okay, pretty good. CapEx to operating cash flow and stock-based compensation is good. Let's have a look at the total revenue. Okay, up to the right. Growing 5% per year. When you have Visa and MasterCard, which are growing way faster, it's a bit problematic, but I guess they do maybe more buybacks. Yeah, they do 2.5%, 3%. Okay, so they mostly do, mostly because of buybacks that they can have this 8%, 10, okay, 11% here. It's probably mostly due to the buybacks and some of the other part of the business. Net income, okay, 5 years, 8% cumulated annual growth rate. Let's have a look at some capital efficiency. Return on equity is good. Return on capital employed is getting better. We had some moment when it wasn't very good. Okay, it's a bit cyclical for the return on capital employed. I'm not a big fan of this. It's a A. It's not a A, sorry. It's American Express, it's a B. Because when you they don't have exactly the same business, okay, but I would prefer to invest in Visa or MasterCard. For me, they are way better. And Kia. Kia, I'm not sure I will have it on the beta of margin. Yep, I don't have it on the beta of margin. I will have it here. I think it's this one, Kia Corporation. So car company, so you have revenue growth, which is good. EPS, very good as well. The return are interesting, and the margin are very interesting for a car company. That's solid. No debt. Very interesting. Let's have a look at the way the margin evolved. If it's just like this now. Let's first capital efficiency. Very stable, it grew. Okay. Capital employed. Okay, this is nice. Operating margin, it's growing. Like they're doing something good here. Like for now, from all the car companies that you proposed, I think Kia is one of the one. It's maybe one of the only one that I kind of like. Not amazing, so it will not go higher than B, but it's a solid B. Like, yeah, Kia is a solid B. Yeah, I mean, I'm quite impressed by the numbers that they have and the way they grow. So yeah, that's something solid. Let's see what are the estimate for the long term. Okay, they have very low growth estimate for the long term, unfortunately, and same for the revenue. But it's still a solid company. So that's all for this one. Let me know in the comment section if you would like another video like this. So drop me some names that you would like that I analyze. I didn't do probably all the companies, so you may have some. Check also my other video. And as well, you can join the margin waitlist. We release every month between 10 and 30 new spots to use it as beta on the beta version. So every month we are adding new features. We're obviously like correcting all the bugs that we will have, all the little problems that we discover while using the website. We did the first launch at the beginning of May. So beginning of June, we'll probably do a new launch for the second beta version, the beta 2, okay? So yeah, just click on the link in the description to join the waitlist and to be informed when we will release, again, 10 or 20 plays for the public. See you in another video. Bye.